Now, in your book, Storing Up Profits, you outline why you find storage units so attractive. Can you talk about some of those specifics?
Yeah, there's when I first heard about value add self-storage, I think I laughed out loud because I was used to apartments, with beautiful floors and lighting and countertops and cabinets and appliances and bark parks. And I couldn't see any value adds in self-storage. It looked to me like four pieces of tin, some rivets, a floor, and a door. Where was the value adds? Well, wow, was I mistaken. There are so many value adds in self-storage. In fact, just the whole premise of self-storage investing to me speaks of value add. Here's what I think the crux of it is. There are 53,000 self-storage assets in the US. That's about the same as McDonald's, Subway, and Starbucks combined. But about 75%, three quarters, are owned by independent operators. And of that group, 2 out of 3 are solo asset operators, which puts them, squarely in the mom and pop category. Now, mom and pops can be run really, really profitably, but often these folks don't have the desire or the knowledge or the resources to make upgrades, to increase income, and to maximize value for their investors. Well, actually, they don't have to, because the value of self-storage has gone up about 2x in the last 7 or so years, because the market really loves this asset class. So while self-storage has gone up, a lot of these assets are still quite mediocre. And so to acquire one of these mediocre assets from a mom and pop operator, upgrade it, put a portfolio of these together and sell them to an institutional player like, a REIT, Blackstone, insurance company, et cetera, it can be an extremely profitable enterprise. So we love the fragmented nature of the business, the ownership side of the business, I should say. Another thing we love is they're recession resistant. I mean, in booms, people are filling up their Walmart and Amazon carts and they need a place to store their stuff. In bad times, people are downsizing. And in COVID, they really, they downsized, they moved, they shut down office spaces, they shut down bars and restaurants, and they often needed a place to store their stuff. And so it is quite recession resistant. Another thing I like is the prices, the rents are quite inelastic. And what I mean by that is, let's put it this way. If I had an apartment I was renting from you for $2,000 a month, and you came and said, you're raising the rent by 10%. Before I sign that piece of paper obligating me to $200 a month or $2,400 more next year, I might think twice. I might move. But in self-storage, if I'm renting $100 storage unit from you and you raise it by 10% again, I might say, well, I'm not going to spend a weekend, get a U-Haul, get all my friends together just to transport my junk, excuse me, my treasures down the street just to save $10 a month. And so this, this opportunity to continue raising rents is also a way of capturing inflation, because, if I have a 20-year lease on an industrial building, I can't raise the rents if they're already set for the next 19 years. Self-storage, you can raise it every month. And a lot of operators, really good operators, use dynamic pricing, and they might change the prices every day. I mentioned value adds in self-storage. There's a lot of them. Some of them are free, like adding U-Haul. You can add U-Haul, let U-Haul, rent their trucks out from the front of your building, and all you have to do is have your employee, clean them out and sign the paperwork and move them out. This can create a value add that would be worth, say, $500,000, $600,000, $700,000 to the value of your facility. I'll take a breath. If you want to go over that math, we can. But again, these are some of the reasons we love self-storage.
Fantastic. Now, a lot of my listeners are more familiar with residential real estate, and to analyze that, you have to do your comps and establish the market value. How do you establish value in self-storage for someone who is looking to start? How does one
One of
go
the
about doing that?
Yeah, one of the reasons we love commercial real estate is, in residential, the last 3 flips I did, we overspent on the improvements, and it was hard to justify the price based on the neighborhood because they're based on comps, and most everybody understands that. Commercial real estate's entirely different. The value is based on math. Now, your mom and dad always told you to be good in math, and I think this was the reason, whether they knew it or not. The value formula for commercial real estate is the value equals the net operating income divided by the cap rate. And the cap rate is the market's evaluation of the rate of return for that asset in that condition, in that location at this time. And so the cap rates used to run around 10%, meaning if you bought $1 million facility for cash, you could expect to cash flow about 100,000, 10%. Now the cap rates are running around 5%, which means you have to pay $2 million to get that same $100,000 cash flow now. That's 5%. In other words, it's the cap rate. Anyway, in commercial real estate, you use this value formula and you can force appreciation. What I mean by that is if you can increase the net operating income, the numerator of our equation, you can therefore increase the value by the exact same percentage. However, if you're using debt, you can even leverage that equity to go even, for example, 50% debt means your equity improvements would be double what they would be with no debt. And so it's quite a sweet deal. It's the reason that I think a lot of people love commercial real estate, because you can somewhat, not completely, but somewhat control the value by how much you can make that math work for you.
Right. So if you increase the income, it's through value add, you have more of a value of the entire unit.
Right. That's right.
Okay. All right. So how do we know that a storage unit, when you're looking for them, how do you know a deal is a good deal? What criteria do we analyze a storage unit with?
Yeah, great question. So if you're looking to buy a self-storage facility, you're going to want to look at 4 things right away. The first thing you're going to want to look at is the radius. And that will be the radius plus analysis specifically. That's a software. You can go online to Radius Plus, and what you're going to want to do is check out the demographics, but more specifically, the square footage of storage in, let's say, a 3-mile radius. I mean, if you're in downtown, a big city, it might be a 1-mile radius. If you're in a rural location, it could be a 10-mile radius. But let's say 3-mile radius for a typical suburban location. You'll draw that ring, and you'll see how many square feet of self-storage is in that ring, and then also how many people are in that ring, men, women, and children. And then you divide that out and you look for a square footage per person. And 7 or 8 square feet per person is the national average. And so if you come out with like 25 square feet of storage per person, like Boise, Idaho, you're probably not going to want to buy there. The competition's way too high. If you come out with a number like 4 square feet per person, like in downtown Atlanta, Georgia, you might say, hey, that might be a good place to locate or buy a self-storage facility. So that's the first criteria. The second one is pretty simple. It's just income. You want to be in the median to high income bracket compared to that area. You definitely don't want to be in a bad neighborhood, because the people who store stuff often wouldn't want to go into a bad neighborhood, even if your facility was secure. Third, you're going to want to be on a well-traveled road. You're going to want to check the VPD, the vehicles per day count in front of that facility. Fourth, you're going to want to be sure that you're really visible on that road. You can be on a highly traveled road, but be down, behind a Walmart where you can't see it over a hill. That wouldn't be helpful. But those are the 4 first criteria I'd look at before looking at a storage facility.